Everyone tells you to invest in the stock market to retire a millionaire in Canada, but no one explains how to start or where to put your money. So let's fix that. Hi, I'm Finance Femster, and I used to manage $1 billion portfolio at one of Canada's biggest banks. And ever since being let go from my day job, I've been chasing my passion, which is helping Canadians manage their money and build wealth through financial literacy that we unfortunately do not get in our education system. In this video, I'm going to break down the 3 major investment accounts in Canada: TFSA, RRSP, FHSA, you name it. And I'm going to explain who it's for, how to use each one, when to use each one, and also help you decide which one will be best for you. Let's get into it. Let's start with the TFSA. The big one, my absolute favorite, the tax-free savings account. This is a beautiful account in Canada where any money that you get inside it, dividends, gains, income, interest, is completely tax-free. You get to keep this, you get to withdraw whenever you want without the CRA taking a pinch out of it. And I know we're all tired of them doing that. So, let's say, for example, you invest $5,000 into an ETF. You heard about this cool ETF that Finance Femster posted on his Instagram. And it grows to $8,000. So that $3,000 of growth, right? All yours. If you want to withdraw the full $8,000, withdraw whatever amount you want, it is all yours, completely tax-free. That easy, that simple. I love it here. With the TFSA, there is a contribution limit. In 2025, the TFSA contribution limit is an additional $7,000. And if you've been eligible from the start of when TFSAs began, you could contribute over $100,000 in your TFSA today. However, I do recommend signing into your MyCRA account online, and it will show you exactly what your specific TFSA contribution limit is. Alternatively, you could give the CRA a call. If neither of those options are easily accessible to you, I will also put a TFSA contribution calculator in the description of this video to make your life easier. Okay? Highly recommend TFSAs because they are lovely for all aspects of the investors, be it you're just getting some savings, you want to get some interest in there, be it you're a long-term investor, be it you're saving up for money for a house, whatever the case may be. TFSAs, the tax-free benefit of it is just a beautiful part of why I'm Canadian. Number 2, the RRSP, the Registered Retirement Savings Plan. Oh, I have a love-hate relationship with this account. So the benefit of this account is anything you contribute in gives you a tax benefit. So you get a tax deduction for any money that you put into this account, long story short. So let's say you're making $70,000 during the year. If you put $5,000 into it, your taxable income is now $65,000. So it'll save you a little bit. The downside is when you do withdraw this money, you're going to be taxed on it. So you can either withdraw it in retirement, when ideally your income tax or your overall tax bill is going to be lower. So the taxes that you'll have to pay on it will be less. You can withdraw this for a home buyer's plan or for education, which in those scenarios up to a certain amount, you won't have to pay any taxes on it. But the other case is if you just need money because you need money from your savings, right? So let's say, for example, you need $50,000 from your RRSP account. Well, too bad, so sad. The government is going to take a 30% withholding tax right off the bat from that money. So you are left with $35,000. This is essentially because for RRSP withdrawals, you are going to be taxed 10 to 30% depending on the amount and also depending on the province, basically all of Canada and Quebec. So Quebec does things differently. RRSPs are best for high income earners, so if you basically want to give yourself a tax break today. It's also beautiful for long-term retirement planning. And lastly, if you want to take advantage of the home buyer's plan or the education plan. Number 3, the FHSA, the First Home Savings Account. This account is the newest of the 3 accounts, and it's actually pretty beautiful because it combines benefits of both the RRSP and the TFSA into one. Similar to the RRSP, it reduces your taxable income whenever you make a contribution into the account. So any money you put into the FHSA reduces your taxable income for the year. There is an annual limit that you can put into the FHSA, which is $8,000 with a lifetime maximum of $40,000. The FHSA is beautiful if you're looking to use these funds to buy your first home. because you're able to withdraw these money fully tax-free to buy your first qualifying home. Unlike the RRSP's home buyers plan, you don't have to pay this money back. So with the home buyers plan, you have to pay the money within 15 years of your withdrawal, versus the FHSA, you withdraw the money, you buy the home, you keep moving. It's beautiful. You don't have to add an additional payments every year like you would with the home buyers plan. Picture this, you're 28, you live in Mississauga, you're looking to buy a house in 4 years, start putting some money into the FHSA, you withdraw that money in 4 years, and you're living, you're good, you're blessed. All right, so the big question is, which of these accounts do you use for your situation? Here's a simple way to think about it. If you're looking to invest, grow your savings, and just want to make money without the CRA taking a cut, no taxes, use the TFSA. Keep putting money in until you can max it out. Enjoy that, okay? If you're looking to buy a home, a lot of people will say, use the FHSA. It's essentially for buying a house. Personally, I still say, use the TFSA. You get to contribute a lot more money than you would in the FHSA typically. The FHSA has a limit of $40,000, right? You're not buying a home in Canada with a down payment of $40,000, I don't think, at least. The TFSA also gives you that flexibility of withdrawing it whenever you want. If you change your mind later on that you want to end up moving to another country, you're not stuck in the fact that, like, hey, this money is for a house in Canada. There's no liabilities on that. Whereas the FHSA, you have to use the money within 15 years of opening the account to buy a house. TFSA, use it for whatever you want, whenever you want. So that's why I love the TFSA. Alternatively, if you are looking to save on income taxes, FHSA is beautiful for that, as well as the RRSP. You get yourself a tax break, you get yourself a larger tax refund ideally. We all love some free money. So if you're looking to just invest, grow your money, build a savings, TFSA is fantastic. Looking to reduce your income taxes, consider the FHSA or the RRSP. Looking to buy a house, FHSA, place to start. RRSP, another way to go. Personally, just use the TFSA, honestly. Especially if reducing your income taxes is not a key driver in your situation right now. I always say max out a TFSA, focus on that, tax-free, no strings attached. Anyways, just remember the most important thing is make sure that you are investing for your goals and your situation. So before you invest, decide what that looks like. What am I investing for? What is my timeline? Why am I doing this? How much will I need from this account when I do need the money? If it's retirement, if it's a vacation, if it's buying a house, if it's a wedding ring, whatever the case may be, you decide that and let your investment decisions be dictated around that initial life goal that you are saving for. All right? All right. Well, I hope this video was valuable and useful for you. And if you think that it will be valuable for a fellow Canadian, please share this along with them. Like and subscribe it as you can. That would really help my situation a lot. Thank you. And I'm really bad at ending videos. So cheers.